You just got to get your cash flow right and get your strategy correct, and you go forward. Because I can tell you, I regret some decisions of waiting for the market to drop, and it just hasn't. It just hasn't. It just keeps going forward.
Hi guys, thanks for jumping on. Today's guests, we have Amir and Shukri from the Property Tax Specialists, and they need no introduction. They have been running an awesome business that specializes in helping property investors maximize their strategy in building strong property portfolios. We're super excited to have them on today. So thank you, Amir and Shukri, for coming on. This is the Property Blueprint. And we're really thankful we had to have you guys on for the first episode, because we've done some amazing work over the years and experienced some really cool things that you've opened up the doors to us, but more so to our clientele, I think, over the years. And that is some of the stuff I mentioned earlier about capital improvement deductions. And so how do we reduce capital gains tax? Well, this was one of those things that you come up with, which was assessing capital improvement when there was nothing available, when you've done improvements and renovations and you've got nothing to show for it. Well, here comes a quantity surveyor, which Shukri pointed out when I sat down with him many years ago when I first started. And you said, oh, look, there was, as a quantity surveyor, could you do this? I said, why not? Yes. This is what we do. We assess property based on information that we know. If we couldn't find it, we search through databases with accountants, councils, and find out when it was built, when NDIS were submitted, when CDCs were submitted, and we then find, here's a property built in 20 years ago that the quantity surveyor estimated, and it's worth $500,000 worth of renovation at that time. Well, technically, we've got $500,000 saving in CGT if you go and sell that property, even though you can't substantiate it yourself.
Yeah, so that's good because it helps out with the cash flow in deductions, as well as the capital gains calculation on the sale.
Yeah,
it just helps minimise what the taxes are.
Certainly.
Thank you for inviting us for the first episode. It's really nice to be here.
No pressure.
Exactly. No, definitely not. Very easy. And you know what, guys? I'd love to start with a little bit of your backstory, how you got into the profession you guys are in, and how you sort of got into the investing space. I know myself and the audience would love to sort of hear, just a brief bit of an intro to you both. Yeah.
Well, you can't see any hair, can you? So I've been around a long time, till a couple of years into 2000.
We call it experience, is that right?
Yeah. Well, yes. in 2000 we changed. We focused more on people with investments in property. We went right through ever since. There was a lot of interest during that year, and there were some promoters there that were telling people they need support. Yep. And one of the support is, of course, accountants and lawyers, etc. And he was telling, but I'm not qualified. And I said, look, I'm qualified. Looked at the guy next door, and says, well, I'm qualified. I can help you out. And we rode on the back of that sort of situation. And then we decided to use a bit of my marketing program, which I did a little while before that, and decided, okay, well, look, let's focus on people with investments in property and just help them out a lot more. And that's how we came about to be property tax specialists until Amir joined me a few years ago and lifted us up quite dramatically since then.
Oh, love it.
Yeah, my background is very diverse. So property, I've been passionate about property since I was a kid, looking at back all the memories. From a kid, I used to go with my granddad. He used to own 2 buildings and he'd collect rents, and I'd be his little minion walking around with him. And since then, my parents also used to invest in property. So I was always passionate about property. I always was very impressed at what they were doing with property. Then I studied accounting, did a lot of different jobs, working in banks, working in developers. And looking back, every single step got me to where I am now, which is quite interesting from a perspective of hindsight. The key thing is I joined Shukri. When I first moved to Australia, I joined Shukri. I was working with Shukri for about a year. Then I left Shukri, worked for a big consulting company, and saw the light and joined Shukri again about 4 years ago. And since then we've been growing the business together. So it's
at least it's verified then. Like if you go away and you come back, you know you're in the right place, isn't it?
Exactly.
Fantastic. No, that's
great to hear. Journey. And I think it's a really good time right now. Here, a lot of people trying to get into the property area as their sort of first investment. And, I think there's a lot of news going out there. So I'd love to ask you guys, what do you sort of see some of the common misconceptions that, early stage property investors, hear a lot of these technical words out there and they can be very confused. Do you see any sort of, misconceptions or things that are being misunderstood out there when it comes to property investing?
Look, when you start out as a first investor, we get quite a few queries. Look, I'm going to invest. What do I do? Well, the first thing you've got to look at is, do you have a strategy, right? Where's your starting point? Where's your end point, right? Because property is quite a long-term type investment, right? So while people will look at, say, negative gearing, which is quite in the news at the moment as the Greens want to eliminate it, right? And then the other side of the thing is, yes, you can have negative gearing, which means your losses, your rental expenses and interest are more than the rent you collect, okay? You offset that against your other salary, you save some tax. But that's today and for the next 5 years or so when you own the property. But when you come to sell it, guess what? All the capital gain is going to be in your name as well. So let's balance out and work out a strategy whose name should be on the property. And by the way, that is going to be the name of our next program, which we're going to do by the end of the month, or actually now at the end of next month.
Yep.
Right? Whose name should be on property? We should look at the ownership structure.
Ownership structure.
Right? Should go on it. And that incorporates a whole lot of issues, incorporating saying, well, look, what's your risk profile? Right? Should you own it in your own name or should we have some other structure?
Okay.
Is this depending on like the type of trade and industry that you work in?
Correct.
Is that when you're going down
Correct.
that route?
Like if you got a surgeon who is a brain surgeon, as we've seen in the news lately, and he's going to have a problem, right, of being sued and so forth, well, you don't want it in your own name.
Perfect.
Right? A lot of the people who own hospitality restaurants at the moment, they're having problems. Right? A lot of the restaurants are closing down. You don't want to lose the house as a result because pandemic shut you down. Right? And so forth.
So
right?
how do you protect your assets
Yes.
while also not specifically trying to avoid creditors? How do you legally do that?
Right. And I think that's a really good point you bring up there as well too, because I think a lot of first-time investors or people getting into that sort of space, they probably don't understand that they have some options of ways to structure things. They would probably go down the standard structure system as in maybe a husband and wife, and they would just go 50-50 partners, but they probably don't realise there is other options and also the reasons you mentioned for protection as well too. So
And again, it's all about making an informed decision.
Yeah.
So what you don't know, you don't know.
Yes.
Once you have the discussion, once you understand your options, you can make a better informed decision at that point in time, because circumstances change, things change in the future, laws change, but you're making a decision based on the information available now. And you're trying to make the best decision at that point in time.
Yes.
And sorry, I'll just jump back to the point you were making about negative gearing and those things. The best option is to have a negatively geared property, but positively cash flowed. And you can achieve that by having a depreciation schedule.
Yeah.
Because that...
Beautiful plug in there, Amir.
Yeah. What that does is it gives you the tax benefits, but it also gives you the cash flow. So you might not need to fund it from your own pocket. So that's also a very good strategy for investors.
Yeah, and we did mention it prior to having this sit down here, is that the depreciation has some great upfront benefits, but it's always worthwhile for people to understand there are some paybacks at the end of the process or transaction when you're done with the property and sell that property and move on with it. When you do the adjustments for CGT, they do calculate depreciation. That's something I always talk to people about, that especially in such circumstances when they say, is it all benefits? Well, no, there are benefits. It's pros and cons. But of course, as you mentioned earlier, it was a cash flow tool, and that's something that people should always
Cash
be
flow
aware
is
of.
very critical in the whole exercise. One of the things we do when we meet people up front is to find out who they are, what they think, what they'd like to achieve.
Yes.
Because that helps us then trying to answer the questions of what they can't ask sometimes. They can't articulate the words. They know what they want, but we're trying to get it out and try and get them into a position to say, yes, are you clear about that? Do you want that? And that's exactly what you're saying, trying to tell the pros and the cons. 100%. And that's how we present it. Say, look, these are your options. Have a look around and see what suits your circumstances, because each person and family situation is different.
And how far do you go down the road of, okay, if I'm a property investor and if I'm a person looking to invest in property and I approach an accountant like yourselves, do we talk about strategy in order to maximize the amount of properties that we can have? And like some people are not understanding of, okay, if I buy one property, it could make or break me in terms of negative gearing, because negative gearing sounds great, tax deductions, but you know, one of those or two of those properties and you've got a very modest income, that could really change the dynamics of your investing journey, couldn't it?
Absolutely. And the key is, like Shukri said, it's cash flow. What's the cash flow? What do you need to sustain yourself? What are the buffers you have in place? And based on that, does that strategy suit you? Because there are so many different strategies. There are so many different alternatives. It's finding one that suits you and your circumstances based on the situation. And when you ask how far we go, I like to go as far as I can go, because the more information I have, the better I can inform decision, provide the advice. If someone doesn't tell me something, I won't include it in my consideration while I'm giving the advice. So it's, it's usually about an open discussion, because for me, I'm looking for the client's best interest. If I don't know anything or I don't know everything, I will tell them what based on the information they provided me. Mm-hmm. So it has to be a very flowing.
And the relationship brings out a few of these things, particularly in the current environment of rising interest rates. Correct. And lenders having a stricter consideration and assessment of the loan application.
Yeah.
Right, so maybe there's a different way to put it together.
Yeah,
right.
We've had people come up to us. I mean, in my own business of doing depreciation, and they come and say, "Oh, we've been told that there's great depreciation on this property." And you know, one of the things I have to tell people is, you know what, you're 100% right. There's great depreciation, but the one thing that's wrong is that we shouldn't be buying property based on depreciation. Yes. That is a big no-no, because it can be very detrimental, especially if you're going to be paying huge sums of money for a property and heavily invested in financially, and that's going to have massive burdens on you. And if that's the last property that you ever buy, depreciation will be such a small factor and you won't even think about it, because it will just burn you that badly financially.
Well, look, one of the things we constantly, Amir and I, say to people, the decision to buy shouldn't be based on the tax.
Yep.
It should be based on the value of the wealth that you're going to generate out of it, which is the growth mostly.
So I was just going to say that point. Like the first thing people say is, I don't want to pay any tax, or I want to pay as little tax as possible.
Yes.
We help them to do that legally, of course. But the point is, they shouldn't plan their life about not paying tax or paying minimal tax, because they could get much better options by paying more tax and making more money.
Mm-hmm.
So it's always how I approach it is, how much money is left in your pocket at the end of the day, not how much you're giving out, how much is left in your pocket. When you approach it that way, you see a light bulb kind of light up in their eyes, and they see, oh yes, now I could be making 100 instead of 60, but I'll be paying a little more tax, but I'll have more left in my pocket. And that's the approach that, once people start realizing that, it's like more abundance, more things come up.
It was actually part of one of my next questions was about the sort of tax. I know we talked a bit about the structure of things at the beginning. One of those reasons was about protection, but I'm assuming another reason would be around tax and obviously trying to put as much money back into the client's pocket as possible.
And add on top of that tax within a time frame. Okay, because you get some savings up front, some savings down the end. What's the total net worth? And the thing is, that's why you need a strategy to work out when your exit points are.
Yes.
Okay, so if your exit point is 10 years down the track and you're in your 50s and you're likely to be retired, then the strategy will be a little bit different. The structure, the ownership structure will be a little bit different. Right? So that's generally how we try and put it all together in terms of a life package as opposed to a yes-no transaction.
And the more information you're extracting out of clients in terms of their situation yields you a better relationship with them, and then you're able to offer a much more tailored service, isn't it, essentially? And that's where value is brought. So it's good.
So we have a lot of seasoned investors that are sort of, listen and watch this sort of show as well too. So what sort of tips or advice could you give to potentially those guys who are, 2 or 3 properties in, and they're looking for new strategies that they may have not yet come across, or some sort of tip that they could potentially use as a strategy for their next property, or something that they could look at that they may have not yet looked at in some things they've already done?
Let's say for New South Wales, properties in New South Wales, more than a couple of properties will take you over the land tax threshold.
Okay.
Okay. So after you've bought 2 properties in your own name and you've reached the land tax threshold, no matter what entity you're going to buy in after that, you're going to be paying land tax. So that is a consideration of whether you should hold the property in individual names or we look at a different ownership structure like trusts, companies. Not
Is
really
that
companies.
including your own occupied
No,
place?
no,
So
the
this is
owner-occupied is
investment
exempt.
only. Okay.
Yes, is exempt. There's a lot of push in the government trying to change things, as you've seen the Victorian government at the moment making some difficult decisions and shifting the weight onto commercial property and so forth. But that's one of the major issues. If you buy in Queensland, for example, then Queensland does allow a threshold before land tax applies for trusts. That makes it easier to buy in trusts in Queensland as opposed to here.
Okay.
The other things is whether you should buy in your own name or one in your name or one in your spouse's name, because land tax is combined on land value.
Okay.
So if you jointly own 2 properties, it's one land tax exemption, okay, rather than 2. So again, that adds to the individual circumstances. Are the people in a good relationship?
Yes.
You put something in somebody else's name but then family law takes over and manages that point.
Well, it's really great to hear, because I think, there could be people out there who may not be speaking to people like yourselves with that experience, who may just be sort of buying a property or buying another property and then, sorting these things out after the fact. But if they take some time and sit with people like yourselves to able to plan for these things, they could do a lot more better for themselves if they plan up front instead of just going out there buying and then worrying about it after.
One of the biggest questions we get after we do one of our webinars or workshops is, I've done this and now I realize it's wrong.
Yeah.
Can I change it? Can I fix it? The answer is always yes, you can.
Okay.
But it's going to cost you a heap load of money. If you considered the advice up front, you wouldn't be in this situation. And that's every single webinar we do. That's maybe we get 10, 15 questions about
How
that.
important it is to have the advisor, the right team up front before we even start the journey, isn't it? For each purchase.
But one has to also recognize that because it's a long journey, right? Life is not black and white. It's shades of grey. Relationships change, people grow up, kids grow up, and things just change. So you've got to recognize that, look, while at that point that was the idea, and if you've got a strategy of an exit, okay, at least you know why you're doing it, okay, which helps mitigate any of the pain if there is going to be any.
Yeah, that's right. People can get very tied to their situation and think that once they do something that they can't change it. But as you guys have said, they can definitely sort of change and it may cost a little bit more now, but they can change.
And sometimes it's a lot better to do it now than later.
Yes.
Like someone who's going to develop something, bought it in their name, they want to do something else in their business. It depends on the circumstances.
Yes.
But that's why we need to understand what the situation is, what's the plan, what's the exit strategy, and then we can help them achieve.
Here's an example. A client yesterday has said to me, he's bought one Western Australia property in Western Australia, wants to buy the next one. The lender won't give him enough money. So he wants to shift the property from his name onto a trust, so he's got a bit more access to loans, okay? And so, okay, I said, look, it's going to cost you a little bit of capital gains. He said, no, I only bought it last year, so there's not much capital gains. All right, that's a tick. Okay, there's no cost. There's a bit of stamp duty. He says, yes, okay, well, I'll pay the stamp duty, but then I've got some savings on the other side. Okay, well, that's not a bad thing to do it now as opposed to 5 years down the track. So, yes, it depends on the particular circumstances, and you can do it. Look at the cost compared to the benefit over the period of time. Might work for you.
And you hear a lot of people sort of, talking about interstate investing these days. And so obviously there's probably going to be different structures, different laws when it comes to sort of, interstate and things like that. Could you touch on a bit of that stuff for us as well too?
So there are 2 levels of tax. There's the federal tax and then there's the state tax.
Yes.
So state tax, each state is different. Like, for example, stamp duties and land tax. So each one has its own rules and regulation. But from a federal level, it's all the same.
Okay.
So whether you own a property in New South Wales, Victoria, wherever, you'll still pay capital gains tax if you make a profit. So that's across the board. So you've got to distinguish between the 2 levels of tax.
2 levels, yeah, perfect. Because, these days here, like I was saying earlier in the thing, people go out there trying to seek right advice and they try to, hear all these sort of buzzwords and they often quite get very, very confused. And, a lot of people, give them advice like you shouldn't buy here or you shouldn't buy there. But I think the message we're hearing today is you need to get yourself a team like yourselves who are able to sort of plan and not just go out there and buy on emotion. I think that's very important. A lot of people may just buy on emotion and not buy with an actual plan or a strategy in place.
That's key because, again, when you're looking at investing, it's about the numbers.
Yes.
It's what am I putting in? Up. What am I getting out of it? So it's a pure numbers game to me. So to me, it's simple. It's numbers. If I'm buying my own home, that's a different thing. Because I'm going to live there. Kids grow up. So it's a much more emotional thing. But if you're talking about purely investing, it's a numbers game. Try to remove the emotions, like you said, out of it totally.
Perfect. And the strategy helps with that.
The strategy.
Yes. So what's your exit point? What's your entry point? What's your cash flow position? What's your total family situation? If your wife decides to have children, if the family decides to have children rather than just the wife, and then that cuts her out if she's out of generating
for the income,
high salaried income for 2 or 3 years.
Yep.
That impacts on how you manage things for a couple of years until she gets back in.
Okay. So if we have some people watching
and just
today,
not to be sexist, he or she. Okay.
Yeah, totally. So if we have some people watching today and they're thinking that they're about to buy their first investment property, or that maybe they're thinking they're way too far off, is there a certain stage where they feel like they should come to get some advice sooner? Should they be focusing more on their savings? Like, when should somebody come and see you in the early stages? Would you like to see someone a year out or 2 years out? When do you think is the right time for someone to start planning their structure?
I always like to say before they sign on the dotted line.
Okay.
That's a definite, because as soon as they've signed on the dotted line, they're committed.
Yes.
Anything before that, it's flexible. They can plan, they can change. And it's always better to understand what you want, because we get people wanting to do something, and after they have the discussion, they realize that maybe that's not actually what they wanted to do, because they just have thought or heard or read online about certain things, or someone told them something, and yes, this is what I want to do. But what that is not suitable for them, or that's not what will get them to their next target and their next target. So the sooner they get the advice, the better. Reading stuff online is beneficial as a starting point, but don't rely on it 100%, because usually there is a missing part that people miss that they don't want to read.
And that might be tight.
And that is, I'm reading, it's tax-free, tax-free, tax-free. I'm not going to pay any tax.
Yes.
But they miss the big part at the bottom where it says doesn't apply to this, this, and this. Yeah. So it's always better to get the advice that's relevant to them.
Especially with the various amounts of circumstances that people can go through. Reading someone's opinion of how you should structure is probably suitable for that person, right? And that's one of those key things that we should take it as a grain of salt.
That's why we offer an initial consult, right?
Yep.
Some people will say, look, it costs money. I say, sure, but we'll rebate it if you ask us to do a tax return or set up a trust or something like that. But the key is at least they're aware of where to start, where to go, what to do, and we explain the fundamental structures of their circumstances within the laws and the environment that's around in the commerce of the property world.
I think that's really good. I think it's really good to give the people the advice. I think people are just often too scared to sort of, make that phone call or get in front of the right people. So that's really important that you guys do offer that service for people, just to get that little bit of knowledge, because, you're right. If someone signs on the dotted line and they don't know, then could cost them a little bit extra money.
That initial consult fee seems rather cheap after some of the potential
savings,
savings or ramifications of making the wrong mistake. But it is rebated if they
come back for more, so they virtually cost them nothing.
Cost them nothing.
Yes.
And we did touch lightly on NDIS. Now, is that something you wanted to get your hands on there?
Look, last week I was speaking to a client. He's looking to do an NDIS project. I was going through the numbers with him. He's very interesting.
That's distinguishing between the property side of the NDIS property available for NDIS service and the actual service providing to the people inside.
So he was looking at buying a property or developing a property, SDA property, specifically designed for NDIS. The returns were quite high, and I highlighted, have you gone through the contracts? Have you looked at all the details? Yes. He had done all his homework, spoken to the right people. But what the key thing is, yes, the returns are high, what they're offering, but you have to have tenants in there. It's just like a normal property. So yes, it's rented specially, and there are certain rates which are higher, but you've got to have people in there for it to generate the income. So if you build an amazing property and can't get the tenants in through NDIS or whichever service provider, it's still a vacant property.
Yeah.
Goes back to making sure that the numbers stack up.
Exactly.
You know, that number
There's
one
a market
rule.
for it as well.
Yeah.
The demand's there.
Exactly.
And is that one of the challenges, do you think, with NDIS? Because it is one of the more common things that we've been asked to prepare depreciation on as a business. But out there, what is the common
I like to keep things simple. Okay, a property is a property. It's just the difference in tenant. So again, back to the point, you've got to make sure that the demand is there, and that's it.
Yeah.
So if the demand is there, you're getting higher returns. It's a good business decision. And as long as the government doesn't change the policies and the guidelines because that's what is increasing the income. So that's another consideration.
The government won't do that. They don't change stuff.
Yes.
Without affecting everybody on its path.
At the start of the podcast episode, guys, you mentioned a bit about an upcoming event that you have on, or a webinar. Could you talk a little bit about what that event's about and who would benefit from that?
We have a couple of webinars which we're planning. They're on the drawing board at the moment.
Yeah, cool.
One that says whose name should be on the property.
Whose name
It's
should be on the
about
property.
the structures, the ownership structures.
Yes.
And the other one is about how to avoid capital gains tax problems.
Okay. And would you say those are for your first-time investors, your seasonal investors, or something for everybody can attend
It's
those?
a beginner, but
Yep.
even if you're seasoned, it'd be interesting to look at whether you are, or you can pick up some things from that as well.
Yes, because, correct me if I'm wrong here, people, just the way they buy their first property doesn't mean they have to buy their second property in the same structure.
Exactly.
Okay.
Yeah. We always position it as if it's a starting position, and while we're talking, we'll add a few bits to take it for
Tailor it
some
to
people.
the order, to your
But you've got to
audience.
be at the basic level because the audience is quite diverse.
And there is no cookie cutter approach. There is
Yes.
no cookie cutter approach. That's the key. You can't just set up trust. And you've got to understand what the client's trying to achieve,
Yeah.
what's their exit strategy, what's their family situation, to give them the correct advice.
Awesome.
Right. Anything else that was worth mentioning? Stamp duty changes.
Stamp duty changes, yeah.
Yesterday, we just picked up
Yeah,
some
but they just changed it.
again. Yes.
Yeah.
So now
They took it away and put it back in where it was before.
and now the tiers are sort of reduced again, isn't it?
That's for Victoria, right?
No, New South
South
Wales.
Wales,
They
yeah.
just knocked out that new proposal from Perrottet to change stamp duty into land tax.
Okay.
Yeah, they came back now to... But what they did is they lifted the scale. Yeah.
I believe under $1 million, we've got different scales now. And I think it's almost tax-free.
Yeah, but it's limited to the value of the property you're going to
800,000,
buy.
yep.
And in Sydney, that's pretty hard anyway.
Yeah.
Right? So the question is just going to be from an investment point of view, we go back to Amir's point of numbers.
Yes.
Right? Does it stack up? Okay. If you're a starting point and you want a step in the ladder, getting that advantage is a good thing. The point is going to be that the market is going to push its price up anyway to make up for it. Okay? And that's what happened in the past. You give a grant and all the suppliers push the price up by exactly the same amount as the grant.
Yes.
So where's your benefit? But at least you have got a footprint in the property market which continues to rise regardless, and the drivers of the property market in Sydney at least, which is population and lack of land, keeps driving it up.
Yes.
Right? So the earlier you start, the better off you are.
That's a great
You just
point.
got to get your cash flow right and get your strategy correct, and you go forward.
And start.
Because I can tell you, I regret some decisions of waiting for the market to drop, and it just hasn't. It just hasn't.
Great point.
Just keeps going forward.
And so for the listeners out there,
Yeah.
that is the best piece of advice
I think so.
Shukri's shared with us, and with his wise knowledge and experience in the industry, is that the market's always there. The sooner you start, the sooner you start to flourish.
And because we speak to so many different people on a daily basis, you see opportunities because they're finding opportunities. So the opportunities are always out there. There are always opportunities, but you've got to be in the right mindset and ready for them to take them on. That's I think distinguishes a lot of people. Whether you take the opportunity that's available, you find it, you locate it, or you don't. You see the glass half full, glass half empty kind of approach.
One last thing that people need to we get questions on is deductibility of interest, right? Because a lot of people will borrow let's say in a different name or jointly, and some person wants the total deduction for themselves, the deduction of interest. Firstly, for interest to be deductible, the loan funds have to be used to buy an income producing asset such as a rental property. Okay? And then it doesn't matter who it is. If you've used it for buying the property, the interest will be deductible, but the deduction will depend on the name on the title. And that's where we come back to ownership structures and whose name is going to be on it.
Okay. Very important.
Yeah.
For advice, reach out to Shukri and Amir from the Property Tax Specialists.
Thanks for being with us today, guys.
Thank you for the opportunity to have a chat.
And thanks for listening, guys. And guys, please subscribe to the channel and like and share if you found some value from this episode.
So guys, of course, the information today is general information, and we've got great guests on here to share information from their experiences as professionals. But of course, the conversations here are based on examples and case studies. For proper advice around some of those tax aspects, please make sure you reach out to your accountant or your advisors or to the great guests here we have today and get the right information and advice prior to making any decisions for yourself.